Good day, traders. This is the daily market live update from the Tradelo trading floor. It's Thursday, the 2nd of May. Some highlights from today's show. Well, Powell says policy is sufficiently restrictive. The BOJ only has 6 more bullets to fire. And is oil signaling a recession? Let's start off with the key risk event for the week. It was the FOMC last night, and Powell very much disappointed the hawks that were looking for some sort of a strong pushback against the recent uptick in inflation. He came out and he told us he thinks policy is sufficiently restrictive. He thinks all they need to do is keep rates higher for longer, and that should do the job of bringing inflation back to their 2% target by 2026. He very much repeated what we had on the 16th of April, said nothing new. Yes, they acknowledge the uptick in inflation, but they think it's very much got to do with shelter, and that we should see shelter disinflation feed into the reports moving forward. So they've kept this dovish stance. They've kept this idea that they are going to cut rates this year. It's now very much a question of, is it 1 cut, is it 2 cuts, or is it 3 cuts like the Fed told us via their SEP forecasts in March. So that's the key takeaway from the FOMC. It was dovish based on the fact that the market came into this expecting some sort of a hawkish slant from the Fed. Now, in terms of market opportunities, there are 2 key markets to pay very close attention to. One is the gold market. Why? Well, gold has been the star outperformer all year as a hedge against higher inflation. Because central banks are all beginning the process of cutting before inflation had reached their 2% target, gold is being bought as a hedge against higher inflation. And that doesn't change. The Fed came out yesterday. They've again pushed back. They've been dovish based off of the recent inflation uptick. And as a result, gold is a buy. It has found some decent support earlier on this week, and it should begin the process of moving back up towards those record highs in the coming weeks. The next market to pay very close attention to is the 2-year bond yield. Why? Well, if you look at a daily chart, you will see 2 yields have battled around that 5% over the last 3.5 weeks. The reason? Well, the market was waiting, highly anticipated for what the Fed was going to tell us. There was some concern that maybe they could be hawkish. And as a result, no one wanted to be long the 2-year. Why? Because, well, if they're going to be hawkish and push higher rates, ultimately that 2-year should trade back towards last year's high around 5.25. However, the dovish tilt came in yesterday, and what that means is that we should see a little bit of a relief rally in the 2-year yield back towards that 470, 465 yield marker. Don't forget, we started the 2-year yield around 4.1% at the start of this year, traded all the way up to 5.05. We have now run into resistance at this 5% yield. So keep a very close eye on those bonds. They should start to see yields peel off a little bit as a result of the dovish Fed. Now, the second key story is the BOJ. They've intervened again. They fired the second bullet. We saw on Monday, on a Bank of Japan holiday. In essence, it was a holiday in Japan, and there was very little liquidity. As a result, they stepped in, they intervened into the market, and they spent roughly $30 billion to prop up and buy the yen and defend the currency. The result, as you can see, is a 3.18% rally in the yen over a period of 3 to 4 hours. So you would have thought, job well done. However, the market had a different idea. Once that intervention was done, we started to see that market drift back over Monday, Tuesday, and into the FOMC. The BOJ was not happy. They didn't want to see this retracement. They intervened again post the FOMC. Now, very, very important to stress, if you notice when they're intervening, Monday, they did it during a Japan holiday where there's no liquidity. In other words, where they can get maximum bang for their buck because no one is on the other side of the trade. That's why we got an outsized move of 3% on Monday. Again, after the FOMC, they came in when we had seen a session of a little bit of dollar selling. Also, the markets were shut, and they intervened again, moving the market another 3% over 3 hours. This is going to be a key theme moving forward. The Bank of Japan's not going to stop intervening if the yen keeps weakening. Now, the question on everyone's mind is, why should the yen strengthen? At the end of the day, unless the Bank of Japan's going to hike those interest rates, investors are going to keep testing the BOJ. So very, very importantly, keep a very close eye on that yen. If we get back to that starting price where we were at the beginning of this week, where we opened around the 157.85, the BOJ seemingly, that's the point at which they're going to intervene. Now, keep in mind, the BOJ doesn't have unlimited reserves. Sure, they've got a lot of reserves. Okay, the thinking is they've got somewhere in the region of about 1.18 trillion in reserves. Of that, 155 billion is deposits and 995 is in securities, which are predominantly treasuries. Okay, now this matters because the thinking on the street is that they've got roughly 300 billion that they could use immediately to prop up the currency. Now, 2 interventions at roughly 30 billion in intervention means they've used 2 of their 8 bullets. Okay, so keep a very close eye in essence, because they are going to run out of ammunition if the market's going to keep testing them. And this is the game that's going to be played by, the big vigilantes. They are going to test that BOJ. They're going to force the BOJ to keep propping it up. But at some point, the BOJ is going to have to sell some of those US treasuries in order to keep getting the funds to buy their own currency. And that's the key. You've got to keep an eye on these interventions, because at some point what you're going to see is you're going to see treasuries come under some sell side pressure as a result of the Bank of Japan selling some of those securities. Okay, the third key story is oil. It slipped yesterday. It was very much unspoken of, but oil was down a good 2.85%. The action started straight after the oil inventories. Now, yes, it was quite a significant build. It was a lot bigger than expected, but that in its own is not necessarily a reason to sell oil. It was technical in nature, so we broke down below some key technical levels. Moreover, we're now seeing the oil inventories run at a 4-week average around 2.4 million barrels. So we've seen this build, this idea of constant build, almost throughout their entire year now. So we're constantly seeing builds in oil, and as a result, we've seen the oil price slip since March. Now, that in its own doesn't necessarily mean a trend change. If we look at the start of the year, for most of the year, the market has been in a very firm backwardation, which points to very good demand for oil. However, and this is what I want to pay attention to on the chart. If you go and have a look at the last 4 recessions, so moving back to 08, and then again, starting in the year 2008, and then sort of around that 2014, we had a little bit of a crisis, a short-term crisis. Then again, 2018, and then obviously COVID 2020. What you'll notice in all 4 instances is that typically speaking, the 4-week average would be well above zero for an extended period of time. In other words, we'd be seeing this constant period of builds in the oil. Now, that in its own doesn't constitute or mean a recession. It's when we get those constant builds that suddenly combine with a market that moves into a very aggressive contango. That suggests to us that in the near term, there's just too much oil because demand is effectively falling away. And that's going to be a real key. Oil is a fantastic leading indicator of global recessions, but it's got to be the combination of an aggressive contango followed by constant builds in the oil inventories. And that ultimately is going to be a very strong signal of a potential recession. Now, that's the key takeaways from today's session. As we move into tomorrow, it is the final risk event of the week. It's non-farm payrolls. Now, what to take away from that non-farm payrolls? Well, the headline number is not as important. Sure, if we got a really smelly number like 50,000 against the 240K expected, that will have a couple of people scratching their heads, because what did Powell tell us yesterday? Well, he said, dual mandate, we don't just look at inflation, we also look at employment. So a very weak number, and you're going to see a rally in bonds. You're going to see interest rate cuts being priced back in predominantly to September. That being said, don't forget the unemployment rate. It's expected to come in at 3.8. Any print above 4% is also going to leave investors scratching their heads thinking, what's going on in the US economy? Now, one final takeaway. It is May. There's a typical saying, sell in May, go away. I push back against that. Okay, we don't want to be stuck in too much of a bias. What we do want to be aware of is that all the key risk events for the last 6 weeks have now cleared. Think earnings, cleared, and cleared with a big green check mark, which is earnings have all beat. Really, really good earnings season. The second one, a central bank FOMC meeting where there was some thinking that they were going to be quite hawkish. Again, bang, green mark, Powell comes out dovish, toes the line, still keeps in play rate cuts for this year. And finally, the Middle East tensions have all but evaporated, and we see that with the VIX now back around that 15 mark. What does this mean? Well, it means we've got green lights for risk assets to begin the process of moving their way back up towards record highs. It's very much the wall of worry has been climbed, therefore we should see a resumption of the trend that started at the beginning of the year. All right, that's a market rack up. Make sure you go and manage that risk, go make some money.